Here is a number that stops you. American Airlines flew about 224 million people last year, more than any airline on Earth. It booked a record $54.6 billion in revenue, and out of all of that, it kept $111 million in profit. That is about 20 cents of profit on every $100 that came in. Now run American through a value screen, and it lights up as one of the cheapest stocks in the entire market. A forward price to earnings under 8, a price barely a fifth of its sales. So which is it? The most flown airline in America, on sale, or a screen quietly lying to you? Start with why the screen calls it cheap. Because the screen is doing something sneaky. Americans' earnings per share last year were 17 cents. The year before, they were $1.24. So the profit did not grow. It almost vanished, down about 86%, squeezed by thin margins and a government shutdown that cost the airline over $300 million in the fourth quarter alone. Here is the trick. A value screen sees that 17-cent base, then sees the company guiding to over $2 this year, and computes a growth rate in the thousands of percent. Divide a normal price to earnings by a 1,000% growth number, and you get a PEG ratio near zero. A screaming bargain. But that is not real compounding. It's a collapsed profit snapping back off the floor. The cheapness is an artifact of the denominator, not a discount on the business. Now, the bigger reason, and it is the one the price-to-earnings ratio completely hides. When you buy the stock, you are buying the equity, and the whole stock market values that equity at about $11 billion. But the airline itself, the whole enterprise is worth about $38 billion. Where did the other $27 billion go? Debt. American carries roughly $31 billion of net debt. So the equity you are buying is only about 30% of the enterprise. The thin top slice sitting on a mountain of borrowing that is nearly 3 times the entire stock market value of the company. That is why the ratio looks cheap. It only measures the little equity sliver, not the leverage underneath it. And a thin slice on top of heavy debt does not just look cheap, it moves violently. Because every swing in the airline's value lands almost entirely on that narrow band of equity. Follow the cash, because it tells you who this company works for right now. Last year, American paid $1.7 billion in interest on its debt. Compare that to its profit of $111 million. The interest bill was about 15 times the entire year's earnings. Lenders get paid first, in full, before a shareholder sees a cent. And the free cash the airline does generate is aimed at the debt, not at you. There has been no dividend since early 2020, and no buyback. Meanwhile, to survive the pandemic, American printed shares. The count went from about 428 million in 2019 to roughly 661 million today, up more than 50%. So even as the business recovers, each share owns a permanently smaller piece, and the cash flow it might one day claim is spoken for by the lenders first. Now the other side, honestly, because cheap for a reason does not mean doomed. American's turnaround is real, and in one place, it is ahead of schedule. Its debt peaked above $54 billion in 2021, and the airline has since cut that by about $19 billion, dropping below $35 billion for the first time since 2015, and hitting its reduction goal a full year early. Revenue is at an all-time record. It is still the #1 airline on Earth by passengers carried, and management is guiding to adjusted earnings between $1.70 and $2.70 this year, with free cash flow above $2 billion. So the bull is not wrong that this is a recovering, deleveraging, genuinely enormous business. The bull is only wrong in one specific way, if it treats the screen's near-zero peg as proof the stock is cheap, instead of asking whether the profit is durable and the debt is truly gone. So what actually settles it? Not the screen. 3 things you can watch instead. 1. Net debt. If it keeps falling toward $25 billion and below, the equity slice gets thicker and safer, and the leverage stops amplifying every wobble. 2. Whether the earnings are durable. If adjusted profit holds inside that guided 170 to 270 range across this year and next, the 1,000% growth was real recovery, not a one-year base effect mirage. 3. Margins. Airlines like American run on operating margins around 2 to 3%. Watch for that to climb toward the 6 to 8% the strongest carriers reach. When net debt is falling and normalized earnings are holding, the discount is turning into a real story. Until then, the cheap ratio is measuring a recovery bounce sitting on a mountain of debt. So, back to where we started. The world's most flown airline, $54 billion in revenue, $111 million in profit, screening as one of the cheapest stocks around. The screen is not broken. It is quietly pricing 3 real things: a profit that nearly vanished, an equity that is a thin slice of a debt-heavy enterprise, and cash flow that belongs to lenders first. That is what cheap for a reason looks like. It is not the same as doomed. The deleveraging is real and ahead of plan, but it is a long way from a clean, free bargain. So the single most useful question is not whether American Airlines is cheap. The screen says it is. The question is whether it is cheap for a reason. Watch the net debt, not the ratio. This is educational analysis of public filings, not investment advice. Verify every figure yourself before you act on any of it.